So, we'll be, as you probably understood, I'm a bit passionate when it comes to sharing the little things I've learned about markets. And so I managed to screw it up and go overboard with the previous presentation. I should have kept the pace quicker. So what I'll do is I'll skip to the third part because I think it's more important. And then so we can leave room for Q&A at the end, because I got a few people who were asking some really interesting questions. And to tell you the truth, I wish they were asked in public so everyone can benefit from, like I mentioned, the little I know. All right, some clarifications. First of all, because I was asked some non-technical questions, like if I work for Trade Capital UK, trade.com, and the answer is no. The good people, Christian actually decided to made the mistake of inviting me as a speaker, so I'll take advantage of this. So no, I do not. I don't have any. I'm not employed by them. Secondly, my new business venture, which will provide training and real-time support and analysis primarily for institutional investors, but there will also be for private investors as well, will be launched soon. I'm going to say soon, before the end of the year. So if someone is interested in learning something in a more structured way, please do contact me. I'm not saying that I provide the way, but just a way. And thirdly, the third point, almost forgot. The third point I wanted to make is that we will have follow-up sessions. Obviously, Christiane hasn't learned her lesson, so she has invited me back. So we will be doing follow-up sessions and that I think it's 2 weeks from now.
Yes.
Right. So it will be online. What we will be going there is in specific strategies. Most of it will be based on the MACDv. And I will also provide some tools which I'm actually, that's a good question. How many are using MT4? How many are using TradingView? So the rest are not using anything or something different? Are using a different product? How many are not trading right now? Okay. So probably it's a third MT4, a third TradingView, a third not trading, and some who's a bit too shy to raise their hands. All right, so I'll try to provide you with TradingView and MT4 as well. And it will be very specific. Now, what I will be presenting now here, all right, there are two associations. One is the CMT Association. It's the Chartered Market Technicians Association. It's the technical analysis equivalent of the CFA. So if someone is looking for a professional designation in technical analysis, the CMT Association provides that. For technicians, it's the CFA for fundamentalists. They have an annual competition called the Charles Dow Award. Well, you provide, when you write a research paper, it's a competition that is open to anyone in the world. And this year, 2022, I won the competition. Well done. Thank you. Now, I will provide the paper. I'll explain the paper. Now, what we will be doing 2 weeks from now is a bit more advanced than this. So today I'll give you the so-called simple version. I also submitted it to the National Association of Investment Managers, of Active Investment Managers, also won first prize there. So thank you. Yeah. So I think you can have some kind of like assurance that this actually works. It's not just pictures on a PowerPoint presentation. Right, so the idea is, the clicker has to work to see the idea. There you go, it's on momentum. So if you remember the roadmap of all the things that we connected, macro, technicals, and then risk management. Now we've gone from macro to technicals, but then there are 5 technical points. A is the trend. Trend is about direction. So for example, if you take your car to drive from here to Southampton, that's direction. The speed that you're running at, that's momentum. And then you've got relative strength. Relative strength is basically comparing one car to the other, how far, it's distance, how far the one has gone versus the other. And then you've got volatility of pattern recognition. So these are my core 5 of technical analysis. And like I mentioned, everything has to be simple and systematic. So without further ado, let's begin. This paper, blah, blah, dedicated to my wife and parents, and also Gerald Appel. Jerry, who passed away in 2020, is the inventor of the MACD. So I took his work and tried to make it a bit better. Right, the first part of the presentation is what is this and what does it matter to you. First of all, then we will look at the limitations of the MACD. When I first asked how many people use the MACD, I saw a show of hands. How many use the MACD? All right then. So I'll show you how you can use something better. Then the solution that is actually being proposed to replace the MACD, but it also has some limitations. And then that was my suggestion, which say improved both of these. And then the histogram, and then a market map model, elementary. We'll show you some examples. So actually the market map model will be doing it 2 weeks from now, all right? So all of this was in the paper, this was not. So we will be covering it 2 weeks from now. And it's not in the paper because when I first made this, this discovery started, because I wanted to be practical, I didn't start to write off a paper. I did it in 2015. So over the years, my work on this has progressed a lot. Then I suddenly thought, okay, let's write a paper. So, if it wins, then, at least have something to show for it. But obviously I could not write the whole lot because that would be probably like a small book rather than a paper. So, okay, what does this topic matter to you? Again, the taxonomy of technical indicators can be roughly put in 2 categories. One is oscillators, which are range bound, who go from 0 to 100, like the stochastic oscillator or the RSI, only the Williams percent R by my good friend Larry Williams. So the problem with this is that when the market really starts trending, for example, in this example to the downside, they get pegged at very low levels. So you get the, what it's called, they got oversold. Actually, it's not oversold because an indicator like this does not measure momentum. It is a range indicator. It is a range indicator. It's just the stochastic oscillator tells you where you are in the range of the previous X days, your look back period. So if you use the default 14, if you open up the indicator and look at the math, you will know that you are not, so if and it goes up into, for example, 80, it does not tell you that it's overbought. It just tells you that within the range of the past 14 bars, if you divide it from 100 to 0, you're at the upper part of it. But that doesn't mean you're overbought. It's just that you're trading at the high part. So it's a bit of a misnomer. And the second types of indicators is unbounded ones, sort of like the rate of change. It can oscillate as much, and it can. Now that's more closer to a true definition of momentum. It goes up and down as much as you can. Now, so my idea, because each one had its own advantages and limitations, the advantages of oscillators is that they are very well defined. So their readings are transferable from one market to the other. Something that the rate of change and boundless oscillators do not have. Because if you compare 2 markets with different volatilities, for example, like natural gas, was Ariel, I think was trading, no, he's not here, natural gas, and some like a fixed income, they have different volatilities. So which means this will be oscillating a lot more and the other one less. So its readings get influenced by volatility, not momentum. All right, so what I would try to have is basically the best of 2 worlds. Have on the one hand an unbounded oscillator, and unbounded, and then have also to be an oscillator. But through this discovery, and when I mean an unbounded oscillator, I mean something that has objective readings like the RSI and the stochastic indicator, and also be unbounded like the RSI, so it's true measure of momentum. So try to combine both. So what is the spillover effect of this effort? That I started opening up new doors, which can be applied to other technical tools as well, as we shall see. Okay, introduction to the MACD. One of the first things I do when I look at indicators of any nature, particularly in technical analysis, is to see the math. Because if you see the math, then you try to understand, reverse engineer what was the underlying logic of the person who constructed it. And then you can also deconstruct it to see what are its limitations and advantages. There is no such thing as perfect indicator. There is no such thing as perfect trading system. These are myths. So let's look at the MACD very quickly. It's a very simple formula. Basically, you take a short moving exponential moving up, average minus a long moving average, and the signal line is the moving average of that. And then the histogram is basically that minus that. So you have the market, one moving average, second moving average. The difference between these is the MACD. So why does Gerald Appel constructed that? Because of a very basic property. Because as the market, for example, increases, you have two moving averages. The shorter time frame one will react faster than the longer one, so the spread between the two moving averages will increase. So when it increases, it means that there is upside momentum. When it decreases, that things are slowing down, because the market, for example, can be going in a sideways motion, the slow moving average flattening out, the long term catching up, so the spread will decrease. So it measures momentum. Now, there is a ways how to measure trend and other stuff as well with it, but let's stay with the basics now. Okay, what are the limitations? So these are the fundamentals of it. Some people use it for signal generation and so on and so forth, but if you backtest it, it doesn't work well in that respect. There are other ways to use it, but let's see its limitation. First limitation. Now this is the S&P 500. Again, I've taken to take full history. Where's the data? Full history. So here's the data from 1957 to 1971. What I did is I recorded the values of the MACD indicator. The maximum was 1.56 and the minimum was minus 3.3. What I wanted to do is see the oscillations of the indicator. From 2019 and onwards, it starts jumping. So the maximum was 86, the minimum was minus 225. Why did this happen? Well, the reason it happened is because the indicator is an absolute price indicator. You have one moving average minus a different moving averages. But these refer to an underlying value, the S&P 500. So if the S&P 500 starts climbing up, you have one minus the other one, which depend on an ever-increasing value. So the absolute value will always be increasing. Because, for example, if you take the MACD on an index which is 100 points, moving average, for example, let me go to the, again, by myself sometime, by Antonis is helping out. All right, so very quickly. So if a market is trending up and give it a value of 100, the short-term moving average, let's say it's 90. The long-term moving average is 80. So the MACD would be 90 minus 80, will have a value of 20. So let's take the exact same example, and the index has a value of 1,000. This has a value of 900, this value of 900. How much is the MACD here? 100. All right, okay. So this is 980, 10. Yeah. All right, so 10 and 100. Now, this does not mean that it has more momentum than this. So the MACDv is larger here than this as a function of the absolute price it is comparing. Is everyone okay with it? So that's the first limitation that the MACD has. It is, and that's why the indicator started going crazy here while it's not, because here the S&P 500 was trading around 100 points. Now it reached more than, at the time of study, more than 4,500. So it was just a bigger price. It did mean it had more momentum. So that's the first limitation. The second limitation is by my clicker. No, it's just, there you go. So the first limitation is it's not stable across time. The second limitation, since it's a function of the first one, if you have two markets which have completely different prices. So for example, the S&P 500 was almost 4,500 at the time of writing of the paper, and the euro had 1 point whatever. But the thing is, so if you compare the MACD on an item, on a market which is 4,500, one which is 1, you'll see you get different completely readings. Because as you mentioned, it's an absolute price indicator, which means the readings of the MACD from one market to the other is not comparable. So you can't say, okay, this MACD is this, the other market is that, so this has more moment to the other one. So the MACD is not stable across securities. So that's the second reading. Second limitation is, again, since it's not stable across securities and time, you cannot have objective overbought and oversold signals like we have with the RSI. Basically, you cannot do a momentum life cycle model. The fourth limitation is that it's signal line accuracy. Because it's a trend following indicator, what's the basis of trend following indicators or strategies? The market goes up, we buy. The market goes down, we sell. The problem with that is they have a lot of whipsaws. Trend following, for example, like CTAs, although they're profitable, but they're profitable in a way which means they have a lot of losing trades, but the ones that do get very profitable, they go on a lot of way. So, but they're not very accurate. The same thing here, it's a trend following indicator. So you probably get like 35-40% of trades correct at best. So signal line accuracy is not very good. And the fifth limitation is sometimes the signal line is very late, because if the market has a lot of momentum to the downside, the signal line and the MACD will diverge, and by the time it catches up, a lot of time will have elapsed. Here is a chart of the FTSE, if I remember correctly. Market had a crash, the MACD gave a very low reading, the market rebounded, but up until the moving averages caught up, it had elapsed almost an 8% rally. So we can try to fix all of these. Signal line timing. So accuracy, timing, being transferred against securities across time, and having momentum life cycle model. So how do we fix this? The first way to fix this, small break, I will be putting the MACD on TradingView and MT4. So you can go around, it's public property, but since I've made it public through, anyone can have it. But the techniques we will be sharing, we'll be doing 2 weeks from now, are not public property. So it will be between us. So PPO. So what does PPO stand for? Percent price oscillator. That's the a way to deal with sum. So the formula is like the MACD, 12 minus 26, because that's the formula for the MACD, 12 minus 26. But then you divide it by 26, so you can have it on a percent basis. So it's not an absolute price oscillator, it's put on a percentage. First limitation. So yeah, you can see some stability of you put some numbers for the PPO ranges, 19 again, over from 1917 and onwards. The oscillator ranges from 2 to minus 2, 95% of the time. So it's very stable. Let's see if it's, let's try to compare it up versus other markets. For example, bonds and natural gas. Will it behave the same way? Let's take the settings. No. Here, for natural gas, in order to have 95% of the readings within a range, you have to go from -7 to plus 0.7. And for natural gas, you have to go from 7 to minus 0.7 because it has a lot of volatility. So although we have solved the first problem, stability across time, it is not stable across securities. And obviously, now there you go. So you can see basically what I wanted to see is where 95% of the values reside. So in order to get that, for the natural gas, I have to go 7 for minus 7, 2 minus 2, 0.7 to minus 0.7. And the difference is between these is not momentum. It is volatility. They're much more. Fixed income is very less volatile than equity markets, which is less volatile than natural gas. And you can see that in your position sizing again. So limitations 3 and 5 obviously remain as the other ones is unsolved. So what is the MACDv? Basically, it's a very simple formula, but we can do a lot of complex things with it. As a friend of mine who's very senior technician said, you can beat infinite complexity out of simplicity. So what did I do? Very simple. Instead of dividing my price, I divided by volatility because that was the defining function. Now, does anyone know what's the average true range? Who does not know who the average range? Don't be shy. Does not know? Oh, pretty much everyone. All right, a small break. What is the average true range? Average true range is basically a measure of volatility. I'm sure a lot of you have heard about standard deviation. Yes. All right, so let's look at average true range. What is average true range? Let's say this is a bar, open and close. This is 90 and 100. Okay, average true range measures volatility as it is defined from the high and the low of a bar. So if a bar it oscillated from this, that's its volatility. So how much is the volatility for the first bar? 25. So this is, sorry, in case you can't make my writing, this is 100 and this is 90. So how much is the volatility for this bar? 10. Perfect. Let's say, okay, this is 195. All right, how much is the volatility for the second bar? 5. So this is a range. Not Gerald, but the guy who invented RSI, Wallace Wilder, invented average true range because there is a small issue here. 5 is the range from the high to the low. But imagine if you had the position here and the market closed here and then it gapped up, because the high is 100 and the low is 110. So there is a gap of 10 points. So would you have profited 5 points or plus the gap here as well? So average true range is a way to measure volatility taking into account this. So he measures it by the close up until the high, because basically that's when you have your P&L, you close to the day, and then from 95 gapped up here, say 112, went back to 110 on 55. So the true range is 95 minus 105, it's 20. Hence why the second bar is more volatile. And that's true range. Okay, so 10, 20, next day might be 15, max might be 8, must be 5. So if you 1, 2, 3, 4, 5, add these and then divide by 5, you have ATR 5, average true range 5 days. Is it clear? So that's your volatility. And volatility is very crucial both for your position sizing and also for your for entries and exit. You can do a lot of stuff with it. So let's keep it very simple. Oh, forgot my clicker over there. Oh, that's nice. There you go. Key concept, volatility. So this is why I divided by volatility to make the indicator more responsive. Okay, let's be fair. Let's the first benefit. again, you can see it's relatively stable across time. So if you do some elementary statistical analysis, you'll see the max value is 273. 95% of the values is within this range. So it is, 150 and minus 150. So MACDv is stable across time. So let's see for the Bund. Will it be the same? And this is the test. Again, 95.9% of the values are between 150 and minus 150. So it seems that it's comparable across time for two securities that have completely different volatilities. Let's go for natural gas. Same thing again. 95.5% between 150 and minus 150. So that gives you the advantage that the MACDv is also not just a true momentum indicator because it's boundless. For example, you can take very arcane up and down values, but it is also confined within certain ranges to truly define overbought and oversold. So if you want to be using one momentum indicator, and I was actually having this discussion with someone during the break, because a lot of people ask, what technical analysis indicator should I be using? And I say, okay, it's like tools. Pick the job you want to be doing and have one tool for one job. One tool for trend definition, one tool for momentum, one tool for volatility. Because you see a lot of people saying, okay, they put on the chart the RSI, they put the stochastic oscillator, they put some other oscillator as well, and they say, oh, they are confirming. But no, they all sing the same song. They're all basically the same thing. So you have one oscillator, one for volatility, and then you can start moving using this. So benefit 2, it's stable across securities, and it will be amazing because the thing is, this indicator, whether you do it on crypto, whether you do it on Amazon, Facebook, it still retains its readings. But the added benefit that it is also boundless, which means that if at any time a market goes crazy and registers a crazy high momentum high, you can take that reading and compare it to other securities. So if you say crypto or natural gas, the MACDv made 100 of, say, 250, that reading has also meaning to other markets as well. So you can truly see, now it was truly very, very strong. Another benefit is that it has a momentum life cycle roadmap, which means you can use it to say, okay, so this is the oversold, this is the overbought, but we can also find values in between which have meaning, which I found it was the minus 50 and the plus 50. If the indicator goes above 50, then the market is moving really fast. If it is between these values, it's usually slow. So if it is below minus 50, it has a lot of momentum to the downside. So if you want to say, if you want to look for a market that has a lot of momentum, look for to the upside, MACDv above 50. If it has below, MACDv below 50. Again, this should be used in conjunction with other tools. It's not the be-all and all, but you can do this. All right, so again, because I like numbers, because the thing is I don't like just charts. I don't want to be making empty claims because I showed you on a PowerPoint presentation. I want to put some numbers to it. So these are the ranges, 4% it goes above 50, 36% of the value is upside momentum. Most of the time it's within this range, 14% to the downside, 1% to the downside. So again, for the Bund, similar numbers. I won't spend too much time. They are significant. You can draw conclusions from them. I'll just leave them here to show you that they're by and large, we're talking about two completely different asset classes with completely different volatilities. The numbers remain the same. Natural gas as well, roughly the same. Again, 2% to the upside, 2% of the down, 2% of the time, that is. So you can use, and now that's what starts getting really interesting. If the indicator is above its signal line, and above 50, you can say the market is rallying. If it is above, it has risk. If it is between 150 and 50, then it is retracing. So what do you do with this? Now you can start quantifying it and say, for example, if a market is above its 200-day moving average, and the MACDv is doing this, you start doing pattern recognition. So a market that is rallying can be easily defined as a 50, above 50 in an uptrend. So you go to your scanners, and then you start looking for markets that are rallying. And that, again, makes you rules-based and also technique-specific, rather than being market-specific. Because a lot of people say, I trade the euro. But the euro doesn't always trend. Sometimes it's very quiet. So what are you going to do? Are you trying to squeeze points out of it? That's not possible. So as far as I'm concerned, I'm technique-specific, not market-specific. I have techniques which apply it across markets. So you can easily program this, and I'll show you some setups in the workshop we'll be doing 2 weeks from now, on how you can do some pattern recognition. And what you're hoping to do is apply it across markets, have multiple strategies across markets, and then you can achieve diversification. You don't bet yourself on having the super strategy. There's no such thing. That's a myth. Okay, so let's do a deep dive. Again, I'm doing more rigorous test here, and this is what, at least from a statistical point of view, gets really interesting. And then I will open. Are there any questions so far?
Can I ask something?
Yeah.
So, you said before that the market is rallying like over 50, or there is a risk over 150.
Yep.
Extreme example, okay, we saw COVID, we had an extreme rally, an extreme rebound basically after the COVID. The number there could be like 300, whatever.
Absolutely.
If you take as a consideration that it's going to be at risk over 150, you don't really know when the market is going for a correction or something. If you take a strategy of like selling or shorting or whatever, do you have like a safety guard, some kind? Because we don't know how long it's going.
Absolutely. That's a very, all right. That's an excellent question. So the question is, okay, if it goes overbought, how do we know when it starts climbing from there? There are ways of trying to figure this out, but as an aside, I will say something else and then come back to it. By nature, and I would highly suggest you become trend followers. So if a market is, like you mentioned, going up, try to buy the market. Now, if it comes to a risk level, that's not a license to sell short, but rather to tighten up your stops or avoid going long. So that's how I use, so I'm switching from technical to trading strategy. Now, coming back to your question, how do we know? Well, there are techniques you can use. For example, one is the signal line. So if it goes up and continues going up 250, 300, and then it turns and it crosses the signal line, that's an assumption that the momentum has changed. So you can use that. But that's not a license to short. I generally do not like to short uptrending markets or try to buy. I mean, I've done it, I'm still sometimes doing it, but there have to be very, very fundamental reasons behind that. So I don't know if that covers your question.
It does.
All right. So in general, try not to, and I'll show you why it is not good to try to pick tops and bottoms, because I don't think that's a sporting, that's a sporting event. It's not a strategy. All right. So when the market, for example, it's an uptrend, okay? Say it registers here a MACDv of say 250. What usually, this is how an oversimplification, but a general pattern of how markets stop. What they usually have is something like this. It may oscillate. It may this. So supposing you pick the top here. If someone asked me, would you like to know the exact price when the S&P 500 or any kind of market would top out? How many would like that information? One. All right. Personally, I would not like it. I'll tell you why. Because if I had someone who could, in theory, I mean, provide me with this information, I would ask them for something else instead. And what I would ask them for is the second rally, because once markets stop, usually there's some kind of a chopping motion. It takes time to trend. This is the tops that I would like. The subsequent rallies. So I'm not interested in tops or bottoms, but what I'm interested is in the second or third, because from here to here, the bulls are in control. Now there is a change in control, and it takes time and it takes effort for the longs to unload their positions and for the shorts into weak hands. And once it changes leadership and changes trend, then the shorts are in position. So what you will notice is that the reactions to the trend are shorter and the primary trend is bigger. Short, big, short, big. So this is what, that's why in an uptrend, I try to find pullbacks, because I want to be getting advantage of this and this and this. Well, in downtrends, this and this. Does that make sense? Yeah. All right. So that's coming back to your question. So even if the MACDv or any other type of indicator managed to show you the top, it's not preferable that you follow that. Keep it as an indication that's why I call it a risk level. It shows you a risk. It's not a topping. That's why I refrain from calling it a top. Keep it on, and once it starts changing in trend, then you can say, okay, I have momentum saying that what's happening may be for real. Okay, now let's try to combine it with other tools. For example, trend, 200-day moving average. So you've got it, say, for example, now you go to your trading platforms and you say, which market should I buy and which market should I sell? The easiest and a very effective way is trend. Say, markets that are above the 200, I'll be buying. Markets that are below, I'll be shorting. And if you're not a big fan of shorting, at least do not buy. That rule alone can save you from a lot of trouble. Follow the trend. Do not buy markets that are below the 200-day moving average. Why 200 and not 250? Okay, make it 250. As long as it is consistent and it shows you that you actually follow, basically 200 was 9 months. Okay, I'll tell you a story that I heard from some senior technicians. Do you know how these numbers 10, 20, 200, 50-day moving average came about? Because everyone reads this in these books, 10, 50, 200, 10, 50, 200. Because the technicians of that were like 50 or 40, 60 years back or wrote these books, didn't have computers. So it was easy for them to round up the numbers. So they were basically adding so to calculate, it made it easy for them to calculate the moving average. So a 10-day moving average was just add it up and then move one decimal to the left. Same thing with 50, same thing with 200. That's how it started and then kept passing on. So there is no magic number. If you want to be keeping it 250, because that's how many trading days there are in a year, keep it 250, as long as it is consistent and meaningful. But don't start curve fitting it. Oh, take the 262 moving average on this market and the 239.4 fall in another one. Just keep it consistent. Okay, so again, the S&P 500, look at how many times. Now, this is very important because not all markets are the same. So you have to make slight adjustments. This is how I mean. The S&P 500, it has an upward bias. Again, I was speaking to someone during the break, and they noticed that there is an upward bias on the S&P 500. So they asked me, what is the best instrument to invest in that? I told them, like, ETFs, if you want to be taking advantage of the upward drift. So how much upward drift there is? Again, from the 1955 to now, you have 9,000 observations. 76% of the time, the market is trending up. If we define up, being above the 200-day moving average. So you have to be really, really careful when you're trying to short equities. I mean, equity indices, that is. really careful, because 76% of the time, you're above it. So, all right, this is a very interesting strategy. Now, if you look at the data, now, as the market goes up, the MACDv ranges move with it. So my question was, how many of the observations of the MACDv were above minus 100 while the market was in an uptrend? 99.4%. Which means that the closer the market approaches the minus 100 level, as long as it is above the 200, and assuming that it will not change its trend, then you have a lot of probabilities in catching the so-called bottom of the correction. So if the market is plunging, and your fundamentals say that its trend will not change, as the closer it gets here, the more confidence you have. And that statistical observation was the nucleus of one of my studies that are the strategies I devised on this one. Again, it's based on math. You just look at it, observe it, measure it, and then make it into a strategy. And what you're trying to do is have a whole bunch of them. So if something doesn't work, you have something else that works in its place. Again, 24%, blah, blah. Again, when you're in a downtrend, it's very symmetrical. 99.8% of the observations are up less than 100. Phew. Which means if the market still remains in a downside, if any reactionary rally that takes the market up to this level, short it. I'm not saying take a mortgage, and bet on it, but the odds are heavily with you. So what you do, take one pattern, code it, and start looking across markets. 5 of them show this pattern, take a very small position in those 5, and then manage it. Have another 4 or 5 patterns, and that's how you do it. Rules-based trading instead of nowcasting, instead of forecasting. Again, with the Bund, same thing, statistical properties. Again, sorry if this is just too numerical, but this was presented for the paper, so it was shown to my peers, so I had to be a bit, verify basically what I'm saying. Again, same thing here. Look at it. Very symmetrical. Very, very symmetrical. 99.8% of the observations. Again, for the Bund. Completely different market, different asset class, different fundamentals, different trends, different volatilities. The properties remain the same. Here is the chart of the Bund. And this is the oscillator. So one strategy that I use, and I actually do use it, is take the 200-day moving average. And when the oscillator is between minus 50 and minus 100, I prepare to buy. That's my setup to buy a correction. Simple as it may sound, but I've got stats behind me to back it up. And I look for this position across market. Any questions so far?
Can you repeat that?
Yeah. I'll be mentioning this in the workshop with more in the one we'll be doing 2 weeks from now. Costs £5,000. No, I'm just joking. Now, well, actually, if I did charge for it £5,000, it would be worth it, believe me. But it will be free. Again, based on this, market is above the 200 moving. Basically, what you're looking for this. The question is, how much can the market fall within its trend and have a meaningful chance of it rebounding? So that's the way to define it. Again, like I mentioned, these have been programmed, and I would be more than happy to share with this. Don't look for any, like I mentioned, super strategy. I will be mentioning it again and again and again. Simple and systematic. Just program it, test it. If it works, try to see if it does across market. Maybe slightly tweak it. Use a portfolio of such strategies, and then off you go. Focus more on research. So, strictly speaking, I spend more time researching than trading. I open up my platform, put on my orders, close it, and that's it. Again, we can, same thing with natural gas. again, back 100%, 99.8%. 90. Again, the observations when it's falling below 100. So this pattern, to put it this way, is this. To put some visual aspect of what the market does and how you can use it. Okay, so market in an uptrend. How do we define the trend? Again, use a 200-day moving average. So the question is, how do I buy a pullback after the market has had a correction? Not a retracement, but a correction. So if the market does this, what is the point when it signals you, now it's a good time for us to start getting in? Assuming, and that's a big assumption, that it won't break behind the MA, it will continue up. Now this question is answered by the MACDv. So if you got it 50 minus 50 minus 150, 50, 150. So that's the indicator. All right, so what you do is you have, first of all, you satisfy the first condition, if then, close above the 200, and as long as the indicator is, minus 100. It's in this area, between minus 50 and minus 100. So you can create a scan. If the market rebounds from here and it does this, instead of this, because we don't know this, we're trying to assume it through fundamentals and other, like I mentioned, it's a probability game. I don't know what the market will do. I'm just trying to figure it out in a more credible way. So if it does this, then look at that. Place that in a scanner and then off you go. Then you can start looking for it. And you can have, again, based on stats, you can start looking for corrections, pullbacks, breakouts, like we mentioned, when it goes above the 50. Will it work all the time? No, it will not. But what you're trying to do, apply it across markets, very small position size, and let the law of statistics work for you. Again, you can have state-specific rules. Now, you can get really deep with this. So you can define it as a mild oversold condition. If mild, I mean, if it's on an uptrend, or mild overbought. So in bull market rules, mild, moderate, and then extreme. Again, this can be programmed, and we'll be talking more about this see some examples, and also perhaps I can open up the floor online so you can ask questions on how you can do this. So you can ideally, once I have my website up and running, it will be able to provide more support. So what I'm hoping in the interim, perhaps make a small group like on Facebook or something, so people can ask questions and say, show me a chart, this is how I do it, up until the website is up and running. Because again, this was a very good question I got in during the break. You've got theory and people stop there. Some people go into so-called practice the markets without having the theory, but you have both. But the ratio between these must be 20% theory and 80% practice. All right, so this is not a magic pill. You have to understand it, apply it, and again, and again, and again, and again, preferably on a demo account, so it's safe. Again, natural gas. This is the principle if you see it in action. So for example, market is below the 200-day moving average, has a huge correction against the trend, and now the indicator is in this level. So by this time, you start realizing it's close to resuming the trend if it does, because it might actually break it. You don't know. So you're saying, I'll play what's the highest probability setup. Same thing here. Now, at a point in time, it will not work, but at least it went straight through. So practically what you're looking to have is, as a trader, if you can have anything from like 55 to 65% winning trades. But the winning trades should be probably 1.5 to 2 times your losing ones. So on the balance of it, the math works out in your favor. Don't go with the expectation, oh, this is the perfect indicator or the perfect market. There's no such thing. You'll be disappointed. I've given up on this a long time ago because I got into the trip of I'll optimize my work again. I will add another parameter, another parameter. Found out it doesn't work. Simple and systematic. No more than 5 parameters. This has 2. I consider it as 2. The trend and the momentum. You can add fundamental filters on it. For example, if you go into the S&P 500, you can add the fundamental filter. Say, okay, I want the trend for bonds. Like, do you remember when we did the first presentation to be above the 50-day moving average? So you go 2, now 3 parameters. 1 technical trend, 1 volatility, and 1 fundamental. Go on. Right, so again, these are the... Have I left the clicker again? Oh, man. Thank you so much. So this is the numbers. Now you can even verify it from other points. Now this was enough. This is a classical swing swing strategy. I mean swing points, a zigzag, some people call it. Harkens into the work of Art Merrill. So basically, what I wanted to do is each time the market has a swing high, swing low, swing high, swing low, swing high, swing low. It's a way to filter out the noise. And what I did is I measured when it has a swing low in an uptrend, when it has a swing low, which is the associated value. Again, trying to attack the point of when can I start entering in an uptrend or start shorting in a downtrend. Again, you can look at the numbers. For the S&P 500, you had 651% swings, swing high, swing lows. Again, I'm trying to verify this from a statistical point of view. Now, 8% were above this. Again, 99% of the swing were above minus 100. So this is your definition of a deep dive. You can also have a shorter one. So right off the bat, you've got 2 very, very good strategies. What's the next step? Coding it. I will provide this for you. And then practicing in a safe environment to see the differences between practice and theory. Because once it gets in and then you try to get in, you'll see, this I got too early, this I got too late, maybe this, maybe that. But after a little while, you'll get the feel of it. But do it in a safe environment. That's why I'm very, very pro demo accounts. Again, same thing for the swing filter. Lots of statistics. I will pass by the numbers because it's heavy with numbers. I've given you the gist of it as simple as I could. Again, I'm making the trend life cycle roadmap 6 stages. Same stuff. You can get more information and more strategies. Again, above minus 50, 98% of the time. This is definition of a pullback. So when we do the webinar 2 weeks from now, I'll present the strategies and then remind you of the statistics. I'll show you this is how it's verified. Okay, so again, the same thing. This is for the Bund. A lot of numbers. They all play out the same thing, above minus 50. When it is above the 200 and above the 50, and it runs at minus 50, 100% of the observations. So as long as the trend remains intact, that's how much it dips statistically. Swing high, swing lows. All right, now let's see the histogram. A lot of people use the histogram as well, which is the difference between the MACD, the MACD and the signal line. Now that's also a very, again, volatility normalize it. But what is the benefit? Again, short-term overbought and short-term oversold levels. Minus 40 and plus 40. Let's look at some examples on the FTSE 100. Now, this is, I don't like having arrows because it's sort of like a signal, but I've replaced this with dots. So I can say you that it's an overbought rather than a signal. So, but you can see that it does manage to alert you when the market is getting really, really frothy. Same thing here. MACDv below 40, MACDv above 40, MACDv above 40, below 40. I will give you my email in case someone wants to contact me for further discussion, further questions, and hopefully I will see you and also provide the tools for you as well to play around with your favorite market. Again, test it. 3 completely different markets. 40% of the time, the S&P 500 is above 43% of the time, below 44. How symmetrical. Completely different asset classes, completely different markets, but the numbers remain the same. So, to cut a long story short, other applications, the 310 oscillator. Has anyone know the 310 oscillator? Right. Basically, it was used by Linda Raschke, we mentioned before, the market wizard. Well, basically, it's like the MACD, but instead of having 12 and 26, you have 3 and 10. But so it's a short-term version of the MACD. Again, you can use here, again, the same properties, and you can do different setups. You can define I found that the 310 oscillator volatility normalized provides very good opportunities for trading pullbacks, short-term pullbacks. Again, statistics the same. So where do we go from here? This is what I call the MACDv system. The work I have showed you so far, and I briefly tried to explain, is public. It's in the paper that I wrote. Going forward, it's private. All right? So, and we will be covering it 2 weeks from now. So what I've done is created again a trend life cycle roadmap based on the moving averages, which then you can use as a screener. For example, if you take all the markets, you can see in which stage the market is, and also the relative ranking, which is the strongest, and then you can see the MACDv values as well. So, first of all, you can rank markets based on their trend. So which markets are up, which markets are down. And by that, you have candidates for longs and candidates for shorts. Do not short above the 200-day moving average. Obviously, the market will reverse its trend, but you don't know when that happens. I guarantee you, you will try it 100 times and you will be successful once. So, and then based on the reversals of the MACDv, I created signals. So it's signal generation. So now there are 2 things to notice. First of all, it's the coloring of the bars. The coloring of the bars respond to the values of the MACDv. So for example, if it's above 50, lighter green. If it's below, it's green. If it's below, it's red. So by color coding it, it's easier visually for someone instead of just double checking the indicator. If you do not want the color coding, fine, no problem. I found it helpful in that respect whenever I do, we see the market technical. If I see fundamentally, take it out. Then also used some, the swings in the momentum to create signals. I don't take all the signals because this is just entries. So what's the difference between, why would you not take? Okay. Again, I mentioned this in the, someone asked during the break. A trade is comprised of 4 parts. What I call the 4 S's. No matter how you trade, your trade will come under these 4 parts. The first part is the setup, which tells you what you want to be doing, long or short. The second is the signal, which means when do I get in? This is not telling you why. This is the why. And this may be technical, may be fundamental, or a mix. So for example, if we say the 200-day moving average, that's technical. If we say the MACDv, that's technical. If we say bonds to be above their trend, that's fundamental. If you use all, that's a mix. Signal, then you have a stop. Where do we get in, get out? And then the size. How much to bet. This is your conviction. Now, some parts you can do. Again, I mean, everything should be rules-based, but based upon your own risk preferences, you can make it. Don't tell me I forgot this the other way.
Yeah.
There you go. Now I'm forgetting from one taste to the other.
Yeah.
Got it. Thank you. You see how excited I get to forget things. So this is the S, the second S, the signals. So first you want to see the setup, where you want to be bullish or bearish in the market, and if it does, then you start following the signals. So the latest signal on the S&P 500 was here a few days before the huge rally. This is the latest chart. This is real time. As real time from my time frame, because I do daily charts, I don't do intraday. And then you can also start creating rules based on the changes in momentum. For example, if it goes, then you can start doing breakouts, or if the market starts changing from an uptrend to a downtrend, you can say, I will not buy, because that is also hugely important. Not just when to do, when not to do things. Again, this is the signals for gold. Again, this is just signals. This is not the setups, because if you've got, say, for example, commitment of trader report, you will ignore in this version, I have all the signals. In other versions of the system, I have it trend filter, which means the long systems may not, the short systems will not, the signals will not appear above. All right? So these are so if you've got fundamental indicators, okay, say I'll bypass the trend filter. If not, I'll be waiting for it and then start trading pullbacks. This is for sterling. Again, EURFX, these are mechanical signals. They don't replace the setups. Crude oil. And with that, thank you for your attention. And if you would like more, my website is under construction. This is my email up until the whole thing is set up, alex@tradertd.com. Feel free to email me and contact me if you've got any questions. And of course, Christiana will be providing more information to you regarding our next online meeting.
Yes, it will be in
2 weeks from now.
On a Saturday
Afternoon, yeah.
Half day, probably 3 to 4 hours.
Yeah,
We'll
probably.
be sending you information, and we're hoping we're hoping to see you there.
But before we break, we'll be having a Q&A, a short
Yes.
Q&A session.
So
So if there are any kind of questions, because I received a lot of questions privately, and I was hoping actually people can speak up in public so everyone can hear the answers, whatever.
What's the last part of the S.M.A.R.T with T? Because we didn't manage to select.
Track record. Yeah, that's a very observant. Well, S for self-awareness, M for market knowledge, A for a trading plan or action plan, R for repeat and review, and T for track record. Because the thing is, so basically the first 3 is about learning the theory. The R, repeat and review, is practicing it on a demo. And once you get, then you go track record, basically build your, there is a way how to go from, demo to live. You set filters, you say you can review yourself every 30 trades and say, okay, I'll take 30 trades. And if I have achieved an X amount of profitability, you have some metrics, then I will gradually launch it live. But there is a process to it. Question?
Hi, can you stress more about the exit strategy?
The exit strategy. Yeah, of course. Are you talking about stop losses or take profit?
No, take profit. Yeah.
Take profit.
Yes.
Right. In general, what I do is I have, depending on the type of strategy I have different exits. So if I want to be trend following, I'll be having a more loose stop. If I want to be doing short-term trading, which most of what I do, then I take profits quickly. Now, how do you take profits quickly? I have two techniques. One is a bit fixed and one is a bit volatile. Let me go back and find the trade, so I can show it on a chart. So the thing is, one is for volatility. All right, so let's suppose we get this trade. Once I'm in this position, so this is how it works. These are basically alerts, which I have a 2-day filter, a 2-bar filter for me to get in. And it go in if I take out this bar's highs. So in theory, I go in this bar. Now, so how do I get out? I have two exits. One is a fixed average true range exit, which means I see how much is the volatility of the past 5 bars. So I want to be seeing how much does it swing, 10 points, 5 points, multiplied by 2, and have it as a target. So that's my one order. The second order is I want to go from Larry Williams, that's the third profitable close. Because the thing is, okay, you have your exit, you have your target, but what happens if the market goes in between your entry and your target? Shall you not take the profits? Because your target is not a guarantee, because the market doesn't have to go to a target just because I set it there. So I have something a bit more volatile, more flexible, sorry. I do at the third profitable close. So once the market goes out, takes this one out, I have, what's the first close that is above my entry? That's what I mean profitable. 1, 2, 3, that's amount. Whichever it gets to first. This is just one technique. The difference is, before you start playing around with these strategies, is to know that trading is a game when you're never satisfied. Because if I buy here and it goes down, I won't be happy. If I buy here and I sell here, but the market goes up, I still will not be happy. So if I buy here and I sell here, I will still not be happy because I didn't pay twice as much on it. I would have said, okay, I should have had a bigger position. So realize that trading is the business when you're never happy. There's no such thing as perfect, buy here, buy there, sell there. It doesn't exist. So that's my strategy. I'll go and take a profit, that's it. I may follow this market and then say, okay, I will look for an opportunity later, but I don't have to chase it. And that's why I come to rules-based being so close to my character, because I don't have to worry what the market will do. I will wait for it to come to my conditions rather than me to chase it around, trying to guess what it does.
Is it same for loss strategy?
Sorry?
Is it the same for loss?
Yeah, for short strategy, yeah, exactly the same. 3 profitable closes. For this I'm talking about this particular strategy. For other strategy, you may have other, but I'm just, in general, short term, I think it's my sweet spot of trading time frames is trades that last between 2 to 5, 6 days maximum. Because I think the market is predictable this time. It's easier rather than waiting for too long or too short. Because on the too long, you have the unknown. In the too short, you've got a lot of volatility and a lot of noise, even worse than volatility. Because what is the leftovers of volatility is called noise. So these are the two exits. You can place your orders on both, small position size, and apply this strategy to 3 or 4 different markets. So the worst thing that can happen to you is if all 3 become unprofitable. But then they have become unprofitable again and again and again, then you start saying worrying. So that's why you start using different strategies. So it takes different the proverbial, the eggs in the basket. I want to have like 5, 6 different baskets. Question?
Yeah, when you're calculating the ATR,
5 days divided by 5, and how do you apply it to the
Yeah, very good question. Okay, so what's the optimal, because there is a moving part to the average true range, which is basically the 5. So the question is why 5, not 6 or not 15? 5 represents basically the past week's volatility. So I want to be seeing what's the recent volatility, because my exit will be based on that. I'm not interested what in general the volatility for the past year. Because if the market is being very quiet, I want to be having exit that responds to this quiet environment. So it'll be a small stop. But if the market is going wild, why not take advantage of it and have a stop which is a bit far away? So that's why I don't do fixed stops, like a 10 pip stop or a 10 tick stop or whatever. It's basically the market tells me what stop to have or what target to have. And the same thing you can use it with your exits. I mean your stop losses.
for the 5 days or whatever.
The average true range.
Yeah, use 5 days and then divide it by 5.
No. Yes. Well, the average true range indicator is already in MT4 and it's already in trading view. So you don't have to do any calculation. So, right. So when you have you plot the ATR and it will show you a value of, say, for example, 10 points, ticks, whatever. If you now, depending on how conservative or how aggressive you want to be, you multiply this number by either 1.5, 2 times 3. So for example, if this is where I got my entry, I will place the take profit at 15 points, at 20 points, at 30 points. But again, this is a matter of how conservative or how aggressive you want to be. You just multiply it by a few times, because one time is basically noise. The average true range basically answers the question, on average, how much do we fluctuate? So if you're below 1, yeah, just a trader in Chicago took a sneeze and the market, and that's how you do it. So in general, again, that's my own personality. I'm a bit conservative, so I go for lower numbers. Question?
So you're saying that you're doing a stop loss at 1 ATR and target 1.3 ATR? Target 3 ATR.
It doesn't have to be symmetrical, but I was talking about take profit. I was talking about take profit.
So the stop loss would be 1 ATR and...
The stop loss, again, if you want to be really aggressive, you will put it under the low of the setup bar. So for example, this bar here is my setup bar. What I do, once I have the setup, I place an order when it breaks the high of this bar and give it a filter of 2 days. And I'm saying 2 days because, okay, the market next day, it might have like say an inside bar, have a rest and then continue. But I want to be waiting for it forever. So if it does, then it gets filled here. Now, stop loss. If you're really conservative, if you're really aggressive, you will put it here. Else you will put it a bit more. The difference is it will affect your position sizing. So that's why I have size at the last position, because you have a big stop, you have a less of a position. And that's in Hebrew, which I do not understand, but I would assume it's some kind of an issue.
It must be okay, no?
Yeah, it looks like an OK inverted. There you go. So, again, stop placement is also a function of one's personality. I can show you the techniques to use, but the application will differ, and that's why I call it semi-systematic strategy. Question?
Yeah, so what's your thoughts around trade journaling in general? And if so, what parameters would you use on trade journaling in order to...
Trade journaling?
Yeah, so as in assessing each individual trade.
Yeah, good question. All right, so in trading journals are if someone asks me what's the best book on trading to read, and I would reply, your trading journal. That's the best book you can read, because there is so much information there. So there are basically 2 types of trading journals. One is the action journal, when you write down where you get in and where you get out. and the one should be the thoughts and emotions journal. Because it's not just keep it as a simple accounting exercise. This is where I go in, this is where I go out, P&L, so on and so forth. This is useful, but it's also you want to be writing down the underlying logic. Because when you flick through it afterwards, you want to be seeing, oh, this is what I did, this is what I was thinking at the time. And maybe you can start evaluating, oh, this is, you'll see a lot of patterns in yourself, or you can keep notes on the chart. Ideally, you want to be use a software like Snagit or some image capturing software, so you can highlight this area and say, I took this trade because of this and this and this. Copy paste it on a Word document, and once you have 30 pages, print it out and read it. It won't take you long. It won't take. Obviously, this process is very difficult to do if you are an intraday trader. That's why a lot of prop trading houses who do have intraday traders, they don't do this type of journaling. They do it over video. But for us, and I stay away from day trading, keep it like that. Just copy and paste it. Make a template for the comments. I took this, and so you can use this. So, for example, use a size stop signal and use a check mark. Yep. To see if you kept everything, or if you broke your the rules, and then have a comment box below. This is what I thought of the market, blah, blah, because of this, and XYZ said this. And then when you've gone over 30 trades, print it out, just 30 pages. And then read your own comments. You'll get, believe me, it's the best technical analysis book you will ever read, your own trading journal.
So just to follow up from that, previously in my journey, if I was ever struggling psychological-wise, I'd close the laptop and reset and start the following day.
Yep.
Do you have any techniques you can use to sort of minimize that process to be able to continue to trade that day?
Are you talking about intraday trading?
So I'm just looking at if you took a swing trade for the following day,
Yeah.
didn't necessarily plan out to what you wanted to.
Yeah.
Obviously, you wouldn't revenge trade, but say if you were trading multiple markets, so you would still need to be trading that day.
Yep.
Previously, I would just.
But why did it affect you? Did you have a big position size?
It was fairly big.
Yeah,
but
that's why.
It was obviously the monetary value, but just the psychological aspect of you seeing it not go to plan. How can you reset yourself to then continue to trade?
Reduce your position sizing and it won't affect you. If you had lost on that trade £2, would it affect you?
Not as much.
It's still a loss. Yeah, it's still a loss, but it's £2.
Mm.
But if you had lost 2 million, so it's not a matter of the trade itself, it's how much you put on it. So that's why one of the benefits of small position sizing, it doesn't have as much as an effect on you psychologically. There are 4 types of trades you can have. Basically, it's a big win, a small win, small loss, big loss. So big win, small win, small loss, big loss. Your job, your first job is to completely eliminate these. Then learn how to balance out so you can have a few of these and at the end of the year have happy days. But eliminate these. And these happen for 2 reasons primarily. Either your size, to put it back in context of the pyramid, risk management. Either your size was too big or your stop too far away. Now, there is a third way, the death by 1,000 cuts, because you keep your stop too close, so you keep losing all the time with very small amounts. But most of the times, this is what happens. I'm just giving it for the fullness of the answer. Another question? So again, the answer would be decrease your position size and it won't affect you so much. Any other questions? No?
So you said obviously you set up yourself with regards to your rules before taking the trade.
Mm.
Do you ever do anything for your personal self to set yourself up to take the trade? Or is it just a matter of having your rules set, knowing where you want to get out and in?
That's a good question. Practicing. I think that's the best way so you can desensitize yourself, because yes, you may have the rules which take a lot of the doubt, but if you take 2 or 3 losing trades, then you might say, oh, I don't want to be taking the next one. So, if you do this often enough on a safe environment, then you will be more prone to following your trading plan. So the question is practice and small position size and diversify across markets. So when you have like in a portfolio of 5 or 6 different positions, even if you have 2 of them in the red at the same time, you still have another 3. You can live to fight another day. But before getting to that, practice.
So your portfolio hedges itself out.
Yeah, by and large, one position offsets the others. So again, I mentioned this during the. So what the idea? I mean, your end goal is to have a portfolio of strategies, not just one super strategy, applied across a small basket of liquid markets. So in theory, this should be happening. So this is your P&L, your strategy P&L. So for example, if strategy A does this, and then you have another strategy which is profitable and goes like this. So both are up, but the one wins when the other one loses, and likewise. So they provide a smoother equity curve. You still lose, but it's one offsets the other one. It's the basic principle of diversification. So that's I think that's the your end goal. Have a basket of strategies applied across a basket of markets with small position sizing. Any other question?
Regarding the stop loss, is there like a percentage or for the specific value for
from the average true range?
The stop loss.
Yes. For the stop loss, the answer is it depends on how aggressive or how conservative you want to be. If you want to be conservative, like so let's put it on a risk. Say I'm conservative and I'm aggressive and somewhere in the middle. This would be ATR 5 times 1.5. Sorry. Times 3. Sorry. And this would be ATR times 1.5. Or the most conservative would be actually, let's put it here. Sorry about this, guys and girls. So this is my entry, this is my exit, below the bar low. So you can have different exits, but they are all depend on how conservative, aggressive, or somewhere in the middle you want to be. There's no one set thing, because someone may feel very strongly about the trade. Now, the caveat is that once you've set your stop, you have to adjust the position size. Because if you have a conservative stop, which means it's miles away from your entry, you'll have to reduce your position size. You can't be trading 5 contracts on a position that is far away and 5 contracts in a position that is very close. So we probably have 5 contracts here with more chances of being stopped out. Now you have 1 contract with less chances of being stopped out. So it's a matter of risk preference. Which one do you prefer?
Well, actually, I would depend on the volatility of the, for example, that crude oil.
Yep.
And especially for if you would take the span of time, if it would be, it's like, for example, for that one, it's slowly like
here.
The first part.
You're here. Yeah, come here. Sure, come on.
So for example, if at this.
All right. Yeah, volatility is very little because very small, because you can see the ranges are very small, and then you have an expansion.
Yeah. So if it would be on a like a reverse, I would be more conservative. Or if
Yeah, you can do. I mean, the thing is, there is no black and white answer. The thing is, as long as you realize what you are doing, that I'm being conservative with smaller position size, or I'm being more aggressive with a bigger position size, you must stop. But like I mentioned, this has more chances of being stopped out. This has less chance of being stopped out. There is no right or wrong answer. There's, as long as you don't do this the opposite, and that's most people take big losses, which I encourage you to do not take big losses, because they take big stops and big position size. They take a big position, and then they say, well, I'll wait for it to come back, and it never comes back, and then wipes them out. Another question, someone?
If you were going to trade during a fundamental movement,
Yep.
What's the best way to go about doing that? Because obviously the strategy you might put in place might be completely rocked out by the fund.
Are we talking about fundamentals or news?
Like a news fundamental.
Oh, I'm the wrong person to ask. I don't trade the news. I mean, I don't get triggered because someone said this and this, that. In theory, I could just be using the charts and my fundamentals, like we mentioned before. So I don't trade the news. Actually, I'm just very wary. So because I know volatility increases and stuff like that, so I don't trade the news.
On a similar point about news and the things that go out in the world, driving the emotions overall. So for short-term transactions, it is very easy to follow, okay, these are the bars and this happened yesterday, this happened last week. But for longer-term investments, they get heavily impacted by what's going on. Like for example, Brexit happened and COVID happened and Liz Truss happened, and then things kept on going and it never recovered. So for long-term investments that are heavily impacted, and we still don't know, and war happened, we still don't know what's going to happen tomorrow. So these rules and everything, they still hold true in for long-term investments as well.
Yeah.
What strategy do you use?
All right. My favorite phrase to use is "I don't know," and I like using this phrase because it makes me revert back to my rules-based. So, going back to your question, what do you do about long-term and short-term? Short-term is like doing windsurfing. Long-term is going like sailing in a big boat. So obviously you'll be going about rougher weather because you're out in the open sea. So for that, in order as a matter of principle, you have to do two things. You have to have more fundamentals in your favor. So you definitely have to have, because big moves happen for fundamental reasons, not for technicals. We use technicals to identify them. Fundamentals are the why. Technicals is the when. So if you want to be doing long-term trading or investing, you have to have very good grasp on the fundamentals, because this will cause the market to give you what you're looking for, the big trend. And in order to capture that, you also have to give it room to breathe, because the more you go into the open sea, the rougher the weather will be. So you have to have a stop which is obviously a bit bigger than that, so you can let it grow. So windsurfing, open sea sailing. Make sure you're, and again, it comes to strategy selection. You have to pick a strategy that is according to your own personality. It doesn't have to be something because I said so. I'm showing you a way, not the way. All right. Another question, because I saw another hand being raised.
I have a question. If I would be buying multiple, for example, that crude oil, I'd be, instead of buying once and then I would add another, would the value be average or it would be separate?
Well, if you have two consecutive days, long and long, I mean.
If, for example, if I bought that
Yep.
2 pounds,
Yes.
and then the second one 2.5, will it be average
No, I take one. No, when I'm.
Would it be like two separate orders that should have been placed afterwards?
So if I understand this correctly, is it about opening a second position or?
Yeah.
No, I don't add to a position. So if I take one, I have to exit it before entering. Because I don't want to be increasing my risk too much. So if I buy crude oil and I get a second signal, what I do is the following. Again, it's a matter of risk preference. Someone can say, okay, increase it. Fine, I'm fine with that if you want to increase it, but you're also increasing your risk. What I do is the following. So I think it's, I wouldn't say smarter, but it's, it has its advantages. So this is, sorry, my drawing goes like shifts like this. I will never be an artist, that's for sure. So if the market has this trend and you get a signal here, all right, so you say your stop here and you set your stop, let's set it here, okay? So this is take my profit. Now, if I get another signal, is this what I understand you're saying? What happens if I get another signal when I'm in a position?
It's like adding another
position.
Yeah.
No, I will not be doing this. What I would be doing is take the position, this one, okay, and say, so for this one, I have my take profit here and my stop loss here. So for this one, where would my take profit be? Here. So I move my take profit and my stop loss. So I just use this as a second signal, not to increase the size, but to move the take profit away. So instead of having take profit 1, so if this is your signal 1, if this signal 2, now I use take profit 2. So I keep signal 1 with take profit 2, if that makes sense.
How about if I, like for example, today I would be buying the underlying shares.
Yes.
And then, for example, I have I received my bonus and then I add another one.
Dollar cost averaging.
He's talking dollar cost averaging.
Yeah, dollar cost average. Well, this is like, so if you're like in a pension fund or something. If you're investing in a pension fund, well, that's different. If we're talking about long-term investing, so for example, someone asks, okay, because the equity markets have a general upward drift, so you do want to be taking a small piece of that by saying have a bit of passive investment. I don't know, saying like have a small position in an ETF, which drifts along with the equity markets. So the question is, when do I put the extra cash in? Well, again, it depends on how much you want to be, when you'll be taking it out. Well, the market, there is no, I don't have a definite answer for this because it's not, well, if you're talking a pension fund, just put it in and then let it out because you will be, for example, for the money I have for my own pension fund, I don't time it. I'm just put it in because I know it will be taking it away 20 years afterwards. I mean, I don't want to be doing market timing with my pension fund. I mean, in theory, I could be doing it, but I'll let it go. Because I have other strategies to do market timing with, not my pension fund. So personally, I just put it there, although it may not be a time the best. So my risk management for that is how much I allocate in that pot. I don't do timing in that one. So like I mentioned, if you have cash for long-term investing. If it is cash for trading, then it doesn't really matter because you just put it in the pot, it stays in cash. When you get a signal, you get it in. But if it's like continuous, sort of like a pension fund, then just personally, I just put it in. I don't time. I might see, okay, I might buy it, refrain from buying it, like I say, I'll get 1 week or 2 weeks from now. But by and large, I don't have it, I don't play in and out with that.
Okay, well, thank you, everyone.
Thank you, everybody.